One of the things that makes saving for retirement frustrating for some people is it can seem it takes forever to be able to reach your goals. But as a financial advisor for over 20 years, I've seen time and time again how people can make a drastic change in their retirement savings in just 12 months. So in this video, I'm going to tell you what those people do and how you can do it as well. And the first one, it sounds trite, but it's so important, is thinking about how you're invested. Many times people think, well, in order to make a positive change to my savings, in order to make a positive change to my net worth, I have to make these big bets. I have to make these big gambles. And you know what? Every now and then that works for people. But for every one person that works for, there's probably 90 people that it hurts. And so the good news is you don't have to be a stock picker. You don't have to be good at picking the company that's going to go to the moon. Does it help to be able to do that? You better believe it helps. But you can still succeed, and the odds are much more in your favor if you forget about stock picking and you instead ask yourself asset allocation. I want you to look at this chart here. And this is by a Brunson study that was done, and they looked at endowments, they looked at the success of professional investors as well as retail investors, and said, what are the factors that contribute to solid results? What are the things that move the needle for investors? And when you ask the public, when you ask people, if you'd asked me this before I got into the business, I would have told you stock selection. And you can see people think that 2/3, 65.1% of their investment success is going to come from stock selection. But you can see in this academically reviewed, peer-reviewed study, it's actually less than 5% of your results are due to your stock selection. It's 4.2%. And then if you ask people, what percent of your success is due to something as boring as asset allocation? What percent of your portfolios in stocks? What percent's in bonds? It's less than, people estimate their perception is, it's less than 10% of their results. But you know what it is? It's almost 95% of your results. It's 93.6%. So the first step is getting that asset allocation right. And I'm going to give you some background as to how to think about it. And we're all different. And it depends on our risk tolerance. It depends on when we're going to need this money. It depends on whether it's taxable or not taxable. It depends on any special situations that you might have. And it depends on what your goals are. One of the mantras of mine is take no more risk than you need to achieve your goals. Now, one of the most important factors is time. And here's why. If we have more time, the likelihood of suffering a severe loss over that period of time, it drops dramatically. Take a look at this chart here. This is by Macro Bound. And this is the probability, the historical probability of suffering a loss. And you can see at the 1 year mark, it's a little better than 50-50, or, when it's at a couple months at the very beginning of this chart, it's about 50-50. The chance of having a loss is actually a little bit lower than 50-50. So you still have better than a coin toss likelihood of succeeding if it's a short period of time, a week, a month, a quarter, something like that. But when we get out to a year, you can see that number drops down to like 40%. So the likelihood of having a loss is 40%. The likelihood of having a gain is 60%. And then when you go down here to, what is that, about 8, 9, 10 years, you can see the likelihood there of a loss over an 8-year period, a 9-year period, a 10-year period, in aggregate, in total, is less than 10%. And when you get out past 13, 14, 15 years, the probability of having a loss drops dramatically. It's pretty close to zero. It's not exactly zero. In fact, if you want to look at rolling 20-year averages, this is of the S&P 500, and this is from a wealthofcommonsense.com. Thank you for this. But you can see here over a 20-year period, the worst case, and this was with the Great Depression, right? So this goes 1926 to 2023. So to get a rolling 20, we need to wait 20 years. So that's why that first data is in 1944. And you can see it dropped down in the worst case situation was 2%, positive 2% per year. But look at this. If somebody has a 30-year time horizon, let's look at this next chart here. This is really shocking. Again, same time period, 1926 to 2023. And so the first data here is in 1953, is that right? 1956, 1957, because it takes 30 years to get that first rolling 30 number. But the worst case here is 7.8% a year, and that includes the Great Depression. So that's almost a 10x over that time horizon, 10 times your money over that time horizon. So time is one of our best friends, but the challenge is if we're retired, if we're getting older, we don't have as much time. Now, in theory, we still might. Let's say you're retiring at 55. You know, a lot of people would say, you know what, I want to invest. You know, I'm hoping I'll live to 85 or 90 and I'll be healthy. And so those folks could rightfully push back and say, hey, Azul, I think I still have a 30-year time horizon. And you do, but it's not like it's going to sit idle and you never need to touch it. There's two things. One is during the journey, you need to access some of that money. And so if you have to sell stocks to meet your living expenses, if the market's down, you then become a forced seller in a down market. So that's one aspect of it is you're taking money out. You don't have that full 30-year period. You're periodically taking money out. And the second one, candidly, is the pain of losing money is much greater once we're no longer getting a salary, unfortunately, right? I call it this river of money. And while we're working, you know, we're on the bank and this river of money, every month there's new money coming in. And if we spend a little more on vacation, if we spend a little more buying gifts for people during the holiday, if we spend more money than what we were planning, well, it's not the end of the world. There's another month coming in. We can tighten our belts and still, you know, make the year's numbers work out. Plus, we have new money coming in. Same thing if the stock market goes down. If the stock market goes down, you still have time to weather that storm because you don't need to take the money out. And when the new money comes in, candidly, you benefit if you're not taking money out when the stock market goes down because you can buy at lower prices. It's called dollar cost averaging. But the evil cousin of dollar cost averaging, right? Dollar cost averaging, you win when the market goes down. But the evil cousin of that is sequence of return risk. For the person that needs to be taking money out, the person that's selling that stock, that the person that's working is buying at a lower price, the person that's selling that stock at the lower price, they lose. And so that's why time is so important. In fact, here you can see this from this chart here. The time in the market, they say it's time in the market, not timing the market. I totally agree with that. But just see what happens if you miss some of the very best days. You know, if you miss one of the very best days, your returns go from 10%, it drops a couple points. And this is over, over a 10-year period. And if you just missed one of the best days, 10 of the best days, 5 of the best days, and unfortunately, as this chart here shows, when the market is the scariest, after the pullback, after the market has gone down, is oftentimes when the market has some of its biggest return days, weeks, months, and maybe even years. So it's important to be able to stay the course. So that's job number one. And being able to make a difference in 1 year in your retirement savings is getting that asset allocation right. And the second one is saving more money. Being able to save as much as you can and developing that discipline. And as I tell people, there's really 3 rules to building wealth. I don't care how much you earn. You need to spend less than what you earn. It's shocking but true. Over half of all Americans that make $100,000 a year or more don't save a dime. Nothing. Zero, zip. So no matter how much we make, we need to spend less than what we earn so that we can save money. It's not enough to just save that money. We have to invest it. That's the asset allocation. And then the other two things I tell people is one house instead of two, instead of having that dream vacation house, and then one spouse. And I say that somewhat in jest, one house, one spouse, it rhymes. And I know not every relationship is meant to be, but if you can make your relationship work, it's worth investing the time and the effort to do that, because boy, you know, if you're getting close to whatever your number is to retire, it's really hard to make up if you end up waking up one morning and you have half of that or less. So that's all defense. And then on the offense side of things, really thinking about how do you save? How do you save as much as you can while still enjoying the journey? And one of the things I like to tell people is the 50-30-20 rule. I know it's aspirational, I know it's hard, but look at what your needs are, things like paying your rent or your mortgage, things like buying groceries, things like buying gasoline for your car to get back and forth to work. Those are all needs, right? Helping out our kids if they're still in the house, and there's things we need to do to help them until they're off on their own. Those are all the needs. Try to keep that to half of your after-tax take-home pay. And then if we can keep our wants, vacation, maybe a nicer car, maybe buying some stuff off of online stores, maybe different experiences, things like that, going on a vacation with your college buddies, stuff like that. Our wants, keep that at 30% or less. If we can do that, that leaves 20% left for our savings. And between those things, those two things, a good offense, which is the saving money and investing right, and then a good defense, making sure we don't make mistakes that cause us to have mental pain, mental anguish when the market goes down. I can tell you the market's pretty high right now. We ended the year 2024 with better than a 20% return. From the trough to the peak, from the October 2022 lows to the October 2024 highs, the S&P 500 was up over 60%, 60%. And you know what? Anything that can go up by 60% can also go down by 60% in 2 years. I don't think that's going to happen, but I don't have a crystal ball. Nothing that I'm sharing in this is financial advice, but one of the things I do know is we're all wise to think about what's the right time for us to retire, and that's why I made this video here, why waiting to 65 to retire might be a big mistake. Thanks for watching this one. I'll see you in the next one. Bye-bye.